What if I told you there's a company, once valued at over $13 billion, that is right now fighting just to keep its share price above a single dollar? Not 50, not 10, one single dollar. And what if that same company just exploded 41% in a single trading session, pulling in 189 million shares of volume in less than 7 hours? Would you call that a company worth watching or a company worth avoiding? Stick around, because by the end of this video, you will have the clearest picture possible of exactly what is happening with Beyond Meat and what might be coming next. Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the data, and find the setups that matter before the crowd catches on. Today, we are going all in on one of the most controversial, most shorted, and most misunderstood tickers on the market right now, Beyond Meat, trading under the symbol BYND. We are breaking this down across 3 pillars: the shift, the catalysts, and the setup. There is also a hidden metric buried inside the debt structure that most people are completely overlooking, and that one alone could reshape how you think about the entire risk profile. Let's get into it. To understand where Beyond Meat stands today, you have to understand where the narrative broke down. For years, this was Wall Street's darling, the future of protein, the plant-based revolution. Then revenues fell, debt piled up, and consumers drifted back to the real thing. For a long time, BYND was the textbook fundamental short. But the story has changed. We are no longer talking about a meatless burger company fighting for shelf space. We are now talking about a company mid-pivot, moving into new product categories and generating retail attention that has turned this ticker into an absolute battlefield. And on that battlefield, a few days ago, something extraordinary happened. On April 20th, Beyond Meat did not just move, it detonated. A 41.02% surge in a single session, closing at $1.16. Volume? 189 million shares in one trading day. Think about what that means. That is an enormous portion of the entire tradable float exchanging hands in 6.5 hours. This was not a random bounce. This was a statement, and it extended what had already been a stunning monthly run, gains exceeding 65% in just a matter of weeks. Now the very next day, the stock pulled back nearly 10% to $1.04. And I know what the bears are already screaming in the comments. See, it's dead again. But here's the question you should actually be asking yourself. What on earth caused 189 million shares to trade in a single day? Because that answer, right there, is where the real story lives. There were 4 distinct engines firing at the same time that ignited this move. First, Beyond Meat struck a major new distribution deal with Geyser, New York City's premier non-alcoholic beverage distributor. This is not about burgers. This is about a brand new product line called Beyond Immerse, a functional beverage that is now hitting 26,000 retail locations. 26,000. That is not a test. That is a rollout. Second, the company simultaneously pushed new avocado oil breakfast sausages into Kroger and Sprouts, targeting the clean label, health-conscious consumer who has been drifting away from the brand. Third, and this one is critically important, Beyond Meat finally filed their delayed 10K annual report, which directly resolved a Nasdaq delisting threat that had been hanging over this company like a guillotine for months. And fourth, we cannot pretend that meme stock energy is not a real force in the market. Retail traders on Reddit and StockTwits spotted the elevated short interest and moved in fast. 4 engines, 1 massive candle. But here is where I want you to pump the brakes and look at the actual chart, because the technicals are telling a more nuanced story than the headlines. In the short term, the bulls are in control. BYND is trading well above its 20-day simple moving average of $0.75 and its 50-day simple moving average of $0.73. When you see price gapping this far above those near-term averages, it confirms strong trending momentum. However, and this is the part that matters, zoom out. The stock is still battling its 200-day moving average, which sits in a range between $1.04 and $1.64. Until we see a sustained break and hold above that long-term average, what we are witnessing is technically a bear market rally inside a much larger structural downtrend. Think of it like watching a high-speed chase on a bridge that is still under construction. Exciting? Absolutely. Safe? That depends entirely on what you do next. Now let's check the vitals on those momentum indicators. The RSI, Relative Strength Index, is currently sitting at 55.36. And honestly, this is actually a healthy reading. During the peak of the 41% surge, the RSI hit 80, deep into overbought territory. Seeing it cool back down to 55 tells us the stock is consolidating rather than collapsing, which is constructive behavior. The MACD is still holding above the signal line, which continues to support the near-term bullish case. But the indicator I want you to pay close attention to is the ATR, Average True Range. It is elevated significantly. What that means in plain English is this: expect sharp, violent, unpredictable swings in both directions. This is not a stock for investors without a clearly defined stop loss. If you do not know where you are getting out before you get in, this stock will find that number for you, and it will not be pretty. And now we get to the part of this story that truly makes BYND unlike almost any other trade on the market right now: the squeeze setup. Currently, there are 141.7 million shares sold short. That represents roughly 31 to 35% of the entire float. Now pause on that for a second. Nearly 1 out of every 3 tradable shares has a short seller on the other end, someone betting this stock goes lower. And here is what is making those bets incredibly painful. The short borrow fee has spiked to between 47.37% and 47.90% annualized. Every day BYND stays above $1, those short sellers are bleeding real money just to hold their positions open. Could we see a moment where all of them rush for the exit simultaneously? The options market is sending an equally aggressive signal. Between 84 and 92% of all options activity on BYND recently has been in calls, meaning traders are overwhelmingly betting on higher prices. On April 20th alone, we saw 1.16 million contracts in open interest. And look where that money is concentrated. Massive positioning at the $1 and the $1.50 strike prices. This creates what traders call a gamma situation, where the market makers who sold those calls are now forced to buy shares of the underlying stock to hedge their own risk. The more the price rises, the more shares they have to buy. It becomes a mechanical, almost self-fulfilling cycle of buying pressure. Could we see a scenario where that gamma effect combines with a short squeeze to send this stock to levels that would make even the most pessimistic bears question everything they thought they knew? But here is where you absolutely cannot let the excitement cloud your judgment, because Wall Street's professional analysts are not buying what the momentum crowd is selling. Despite the 41% single-day move, the analyst consensus on BYND remains a strong sell. 7 sell ratings, 2 holds, 0 buys. The average 12-month price target sits at just $0.82, nearly 20% below where the stock is trading right now. Barclays is even more bearish, with a target of 50 cents. Their argument is straightforward: $1.2 billion in debt, a 20% year-over-year revenue decline, and a business model that is structurally challenged. They believe the math does not work, regardless of the short-term excitement. So if the analysts despise it, why are the biggest names in finance quietly increasing their exposure? Institutional ownership in Beyond Meat actually remains quite high at 52.48%. And in the fourth quarter of 2025, giants like BlackRock and Vanguard meaningfully increased their positions. Now, are they making a bold contrarian bet on the strategic pivot? Are these index-related purchases they have no choice but to make? Either way, the picture you get is this: professional sell-side analysts are screaming sell, while the largest asset managers on the planet are buying more. That tension right there, that is the real story of BYND in 2026. And that brings us to the most important question you need to answer before you even consider touching this ticker. Are you a trader or are you an investor? because this stock serves completely different purposes for each. The short-term trade is driven by sentiment, news flow, short squeeze mechanics, and options gamma. You are watching volume, borrow fees, daily RSI, and news catalysts. The long-term investment case is a dramatically harder sell. You need to see gross margin expansion, and right now it is a razor-thin 2.8%. You need to see the cash burn slow. You need to see BYND Immerse actually generate real, recurring revenue. Do not confuse a great trade with a great company. Those are two very different things, and mixing them up is one of the most expensive mistakes a retail investor can make. Now let's get actionable. On the downside, $0.95 to $1 is your absolute line in the sand. That is the major psychological floor and the Nasdaq compliance threshold. Below that, the next area of support converges around $0.72 to 75 cents at the moving average cluster. On the upside, $1.20 is the first momentum trigger. A clean break above that level with volume behind it opens the door to $1.50, where all that call option open interest is concentrated. And if we somehow get through that, the final boss level is $1.70, the upper bound of the 200-day moving average range. That is where serious structural resistance lives. For those watching this trade closely, the entry zone of interest is the $1 to $1.01 range. But it requires a sustained daily close to be considered valid. First target is $1.20 for near-term profit taking. If a true gamma squeeze develops, target 2 is $1.50. And your stop loss, this is non-negotiable, must be a daily close below $0.90. If it breaks that level on a closing basis, the bullish roadmap is done, and this stock almost certainly reverts back into deep penny stock territory. Why does that $1 level matter so much? Because it is not just a number, it is an existential threshold. Nasdaq rules generally require stocks to maintain a minimum bid price of $1 to remain listed on the exchange. While the recent 10K filing resolved the reporting delay that triggered the initial delisting warning, staying above $1 is the key to BYND Meat's survival as a publicly traded company. If they lose Nasdaq listing status, the meme momentum evaporates overnight. Institutional investors operating under internal risk mandates could be forced to liquidate. The game changes completely. That $1 line is not a support level. It is a lifeline. And now, a word before we wrap up. Nothing you have heard in this video is financial advice. I am not a licensed financial advisor, and Smart Stock Sam is an educational and informational channel only. Every investment carries risk, and stocks like BYND carry exceptional risk. Always do your own research. Consult a qualified financial professional before making any investment decisions. Past performance is never a guarantee of future results. Trade responsibly and never risk capital you cannot afford to lose. So here is the final verdict on BYND Meat. The opportunity is real. The big Geyser distribution deal and the breakfast sausage expansion into Kroger and Sprouts provide tangible, near-term catalysts. The short squeeze mechanics are alive. The options positioning is aggressive, but the risks are equally massive. Declining revenues, mounting debt, and a razor-thin gross margin mean the fundamental foundation is still deeply stressed. BYND Meat in 2026 is a high-risk, news-driven trading vehicle. If you choose to play it, disciplined risk management is not optional, it is mandatory. The meme momentum that sends it flying can reverse just as violently as it arrived. Watch that dollar level like a hawk. Now here's my question for you, and I genuinely want to know what you think. If BYND Meat successfully launches BYND Immerse into 26,000 locations and actually turns it profitable, does that change the long-term investment case for you? Or is the debt load simply too heavy to overcome no matter what? Drop your answer in the comments below. I read every single one. If this breakdown gave you clarity on BYND, hit that like button. It genuinely helps more people find this channel. And if you are not subscribed to Smart Stock Sam yet, Now is the time, because we are just getting started on uncovering setups like this one before the crowd shows up. And if you really want to support the work we do here, you can send a super thanks directly through YouTube. Every single contribution goes right back into making this content better for you. I will see you in the next one. Stay sharp, stay disciplined, and as always, trade smart.